Good morning, and welcome to episode 278 of Getting Rich. I'm your host, Rich Chekin, president of Asset Strategies International, and today is Wednesday, May 27th, 2026. Russia continues to bombard Kiev while making more frequent and bellicose statements toward Baltic states like Latvia. Russia is accusing Latvia of hosting Ukrainian drone staging sites for missile attacks. Latvia denies these claims, but Europe is concerned that Russia is signaling a desire to take this conflict to broader Europe outside of just the borders of Ukraine. Back-channel discussions between the U.S. and Iran suggest progress is being made toward a deal, despite the fact that the U.S. launched last night defensive strikes both in the Straits of Hormuz and on missile launch sites. Iran needs some serious help economically. They are struggling under the sanctions and with the impact of the choking off of the Straits of Hormuz. So they're looking for some economic aid here, would like to end this conflict, but they also do not want to give up any ground with regard to the nuclear issues that separate the U.S. and Iran at the bargaining table. In the meantime, gold and silver continue to languish. Let's go ahead and take a look at the prices over the past week. Gold is down another 1.1% this past week. It's trading at $4,445.50 an ounce this morning. It was $4,497.20 last week. Silver's down 1.8%, trading at $74.45 an ounce. It was $75.81 last week. Platinum's down 1.2%, trading at $19.28 an ounce. It was $1,951 an ounce last week. And palladium is absolutely unchanged, trading at $1,394, exactly where it was per ounce last week. With gold falling a little bit less than silver, it's going to take more ounces of silver to buy that ounce of gold. So your gold-silver ratio is up slightly to 59.71. It was 59.32 last week. And the dollar gave up just a hair. It was 99.36 on the index last week. This week it's at 99.13. Still below 100, still signaling weakness for the US dollar going forward. So I have a question for you. Kevin Warsh, the new Fed Reserve Chairman, was sworn in last Friday. He'll participate in his first rate-setting meeting of the Federal Open Market Committee later this month. Do you think the Fed will raise, lower, or keep rates unchanged at their June meeting in a few weeks? I'd love to hear your thoughts. I raise that question because I'm hearing a lot more rhetoric out there about the fact that it looks like with inflation persistent and on the rise, and with the continued conflict in Iran, the impact on oil prices, and what that does to producer price index and eventually to consumer price index over time, the belief is that inflation will continue to rise and the Fed will not leave rates unchanged, will not cut rates, but they will actually raise rates. And the concern here is that that is considered bad for gold and silver. And I just want to caution you, do not let that rhetoric scare you out of doing what you should be doing right now, which is to buy gold and silver, protect your purchasing power going forward. The reality is, at these levels, the impact of interest rates to dissuade you from buying gold and silver is absolutely zero. We've got interest rates at 3.5%. That's your return on a term deposit. The inflation rate is above 3. You're basically making absolutely nothing if you own a term deposit. It is not worth that to take away from buying gold and silver at this point. I agree that higher interest rates, much higher interest rates, are bad for gold. We are nowhere near that levels. There is great value in the precious metals market right now with the decrease in the spot price and the low premiums, and I strongly suggest you take full advantage of that going forward. As always, we'd like you to go ahead and subscribe to our YouTube channel. Send us your comments and questions. Like us if you're so inclined. Follow us on social media. Take our twice weekly, always something interesting alerts and our once monthly information line newsletter. But in the end, don't ever forget, getting rich starts with keeping what's yours.